Mortgage prisoners will pay for their loyalty. If you own a home and you have a mortgage, well, this is something you need to look into. We're going to talk about everything that's really relevant to your situation at the moment, what's going on with the lenders, and one tip you can use that will bring your rate down today. So let's start off on the top. We know that the loyalty tax, or the gap between existing mortgage customers and what they're paying versus the discounted rates that customers get for new lending, or banks use to lure new customers, has widened to a record level. And we've seen a recent analysis showing that this is something that a lot of people aren't aware of, and homeowners need to start shopping around for a better deal. So let's have a look at what this gap looks like and why this is actually happening. Before we do, if you like our content, you're a homeowner, you're interested in all things finance, be sure to hit that subscribe button to keep up to date with all things finance and property. So what is the gap we're talking about? This is the gap that the banks have between rates they offer for new customers and the rates existing customers get. Think of it sort of like insurance. When you have an insurance policy, each year renews, and each year they try and increase that cost to you so they make more money, but they lure in new customers with lower rates. Same thing's happening here with mortgage. We can see the Reserve Bank of Australia has kept an eager eye on this differential between what outstanding existing customers get versus what new loan customers get. And we can see over the last 3 years, the data here shows a pretty significant increase. Previously, the gap between what new customers were getting in 2019 and existing customers were getting was about 0.32%. We can see that here on the screen. However, as time has passed and we've seen a massive amount of rate increases in the last 6 months, we can see here that in August 2022, the rate difference between what a new customer is getting, which is about 3.96, versus an existing customer of 4.44 is nearly 0.5%. So we can see that has massively increased in the last 3 years from 0.3% to 0.5%. And that's something that might continue to get worse and is a real worry, because we've seen a lot of changes with the cash rate and people's ability to borrow, which might actually mean people are stuck in their mortgages. So let's have a look here. We can see that borrowers are starting to feel a pinch with higher interest rates, and house prices are falling, which is actually pushing people's loan to value ratios down. So this is something that banks look at. Typically, when you refinance, you want to be refinancing at an 80% lend or lower. So for example, if your property is worth $500,000, then 80% of 500,000 is $400,000. So if you're lending more than $400,000, it's usually not worth refinancing because you have costs such as lender's mortgage insurance. And we've seen recently in certain areas, prices have dropped, particularly in Sydney and Melbourne, where you might have previously purchased, you're at a high loan to value ratio, high borrowing percentage, and now you're in a position where you actually can't refinance. So that's a real worry, especially with all these rate rises and customers not really getting looked after if they've been with their lender for a while. The banks are actually putting that gap up and trying to, give you a higher interest rate. Now, many recent borrowers risk becoming mortgage prisoners as they face difficulty with refinancing or potentially not qualifying for a loan due to their reduced borrowing capacity or higher LVR. So LVRs is what we talked about before, where your loan to value ratio is high, in which you'd have lender's mortgage insurance, and it doesn't make sense. We've also seen borrowing power reduce quite significantly. So in the last 6 months, we've seen 2.5% rate increases. So what that meant is if you got a loan 6 to 12 to 18 months ago, you would have qualified based on the bank's criteria at the time, where they went, you're getting a 2% rate, we add our buffer of 2.5%, we'll assess you as if you're paying a 5.5% loan. Now, fast forward to today, when you go for the same exact loan, you haven't changed anything, your circumstances haven't changed, your income hasn't changed, you're not going to qualify, because now the banks are looking at the rate you're getting, which is, call it 4%, plus the 3% buffer. So it's not 2.5% anymore, it's 3%. And they're saying, can you afford a loan if it goes to 7%? So a lot of times for borrowers, if you've lent initially at your limit, you've lost about 25% in borrowing power with all these rate rises. You actually can't refinance. So that's a bit of a worry there for those that have previously recently got their loan, they lent quite high. Maybe they've seen a great increase in the last 24 months with the price rises we saw in 2021. It come down a little bit and they're wanting to refinance, but they actually can't do it. So that's something that is certainly concerning. We see the latest data shows that loyalty tax for existing customers has hit a record high in July. And if we look at the Wayback Machine, so this machine lets us go back on banks' websites to see what their rates they were offering and how that translates to customers today if they had an existing loan. We look at St. George as an example. They're an easy one because they have their rates on their website. This is in April 2022. So this isn't that long ago. We saw the Reserve Bank starting to increase rates in May. So in April of 2022, the official cash rate was 0.1%. So that's a cash rate. There was no changes at that time. And the variable rate you could get from the bank at the time was 2.09%. So if you got a loan with St. George back then, you'd be laughing. You'd be like, beauties, I'm on 2.09%, happy days. Well, we saw rate increase after rate increase after rate increase. So we've seen 2.5% increases in the last 6 months. The official cash rate now is at 2.6%. What does that mean? So if you had this existing loan, you're now paying 4.59%. 4.59%. Remember that, because if you go to St. George today and you apply for a loan, they're offering sensational rates for new customers of 4.09%. That's 0.5% difference. And what's worse is St. George doesn't negotiate for existing customers to give them new to bank rates. So you cannot get this if you have an existing loan with the bank. They will simply say, no, you don't qualify. Read the fine print. It says for existing customers only. So this is a real problem we see at the moment. There's a bit of a disparity. So we're going to go through what you can do in a moment if you have had your existing loan, you're a mortgage prisoner, and you're finding that the rate rises are having an impact on you and you want to get your rate down. So that's certainly something we've seen a lot of. And we can see the discounting is widening. 0.48%. Is the difference between what new customers get and existing customers get. And this is the highest level since the RBA started recording 3 years ago. Now, the cohort of customers that are paying rates that are more expensive than new customers are actually going to feel the pinch most in the fact that there's not really much they can do. A lot of banks aren't really that proactive in repricing for existing customers as they are for new ones. And let's talk about what you might be able to do if you have a mortgage. So the first thing is, if you're banking with, NAB, Westpac, whoever you're banking with, put in Google NAB discharge form or Westpac discharge form and find the bank's discharge form. Even if you're not leaving, what you can do is threatening to move banks. You don't have to actually start the process. You just fill in the discharge form like so. So you go to the bank's website. Sometimes they'll make you actually call them. Other times they'll let you fill in a form, but you want to complete the discharge form. So we can see the discharge form is here. You click on that, you fill it in. And usually what will happen is the bank will call you. So you fill in the discharge form and you just say, hey, I'm moving to Commonwealth Bank of Australia. Fill that on the discharge form. You don't even have to start a finance application. You can fill it in and bluff them a little bit. The bank will generally call you and say, hey, John Smith, why are you leaving us? We can see you've been with us for a number of years. Before you go, let us try and retain you. So they'll try and give you a new rate, new rate that might keep you, particularly in the circumstances where you can't refinance. This is probably your best avenue to bluff the bank, fill in a discharge form, and then see what they come back to you with. A lot of times they are trying to retain you due to the fact that we've seen record levels of refinance activity going on. The bank's retention teams have been buffed up. They're trying to keep as many customers as possible. So that's the one thing you can do right now, right here. Go into Google your bank name with discharge form on the end. They'll either give you a contact number, you'll have a form to fill it in, say you're moving to a bank. The pros and cons of this is there is no cons. The bank's not going to release your mortgage unless they're getting the money. So even if you fill in the discharge, nothing happens. Doesn't really matter. But the pro is a lot of times the discharge team will call you. If you don't want to fill in the discharge team, call your bank and tell them you're leaving and then see what they say. See if they try and retain you as a customer that they want to keep. So that's the first thing you can do right then and there. Now, the other thing to keep in mind is we have seen new research showing that 64% of Australians are worried about meeting their mortgage repayment. We're seeing a record number of fixed rate mortgage holders coming off, and they're likely going to be hit the hardest. So if you are struggling, don't bury your head in the sand. Each bank has their own financial hardship team. Commonwealth Bank's right here. You can Google it. You can contact the bank and let them know if you are struggling. It's better to be open and upfront and honest with the bank so they can help you and you guys can find a solution that's going to meet both your requirements and theirs. Changing your loan to interest only. Maybe putting a pause to mortgage repayments if you've lost your job or something's happened. Be open, transparent with your lender, because the last thing you want to do is say nothing. Then you're going to have defaults, you're going to have issues with your credit, and you're really going to struggle to do anything there moving forward because credit reporting data shows these sort of events for the next 2 years and even sometimes 5 years if you're in default. So certainly something to think about. The other thing to keep in mind is the bank's retention teams will generally make contact with you. Sometimes they're not going to give you the best deal. They'll say that they're giving you the best deal that they can do possibly based on their metrics they have in their background, but if you go online, you'll see that chances are you're going to get better rates elsewhere. So this is where you can get in touch with us and have a look at, reviewing your situation. We'll be completely open, honest, and transparent and let you know if the bank's retention pricing they've given you is the best they can get. Another thing you should be thinking about is if you're on a fixed rate, start preparing today for what your repayments will be when your rates come off. So on our website, we've got a repayment calculator. Let's say, for example, you've got a $500,000 loan. You fixed it in previously. Fixed rates we were getting only 12 to 24 months ago was 1.99% for 2 to 4 years. You're only paying $1,800 a month at the moment. So what happens if your fixed rate is coming off in 6 months' time? Well, start preparing yourself for the high repayments. So if you're paying $1,800 a month at the moment, work out what rates are likely to be. At the moment, I'd say work on 4.5%, maybe even 5%, because in 6 months' time it could be higher, even 6%. But let's take 4.5% at the moment on the same loan of $500,000. That means you're going to be paying roughly another $600 odd a month, $2,533 compared to $1,846. So instead of paying the bare minimum, start putting that surplus funds directly in the loan or put it somewhere else where you can't touch it so you can get used to it and you're not going to find yourself in a position where you're going to have that mortgage stress. You're going to have that huge rate shock where your rate goes up. You can gradually move up to it. So maybe don't pay the $2,500 per month at the moment. Maybe go from $1,800 to $2,000 this month. And then in a few months more time, increase it to $2,200 and then to $2,500. So this is something you can do so you're going to be used to and really prepared for these rate changes that are coming. Remembering here at Hunter Galloway, we are mortgage brokers. We're based in Brisbane. We deal with people Australia-wide. So if you're looking for a mortgage broker that can help with refinancing, buying your investment property, upgrading, downgrading, first home, we can help. Call us on 1300 088 065 or visit our website huntergalloway.com.au. Get the free assessment button, fill in the details. We'll give you a call directly and go through all your situation. Guys, thanks for watching and we'll see you again soon.